Alright, so this video we're going to look at cars. We're going to talk about how much you gotta, figuring out how much you gotta pay each month for as a car payment. Talk about gasoline, other expenses with cars, and all that good stuff. Alright, so we've got loan payment formula for fixed installment loans. That's just the amount of money you're going to pay every month or every week or whatever. Typically, when you buy a car, you've got monthly payments. So the loan payment formula for fixed installment loans is this right here. It says the regular payment amount, which is abbreviated PMT, required to repay a loan of P dollars paid N times per year over T years at an annual rate R, and of course R is in decimals, is given by the payment is equal to P times R over N divided by 1 minus 1 plus R over N to the negative NT. All right. So this right here, this formula right here, that's how we figure out your monthly payments or yearly payments, weekly payments, whatever it is. Typically, it's monthly. All right. So let's look at example 1. All right. It says, suppose that you decide to borrow $20,000 for a new car. You can select one of the following loans, each requiring regular monthly payments. Installment loan A, which is a 3-year loan at 7%. Installment loan B, which is a 5-year loan at 9%. So they want us to find the monthly payments and total interest for loan A, and then find the same thing for loan B, and then compare the monthly payments and total interest for the two loans. All right. So let me move this down so we can have some place to work. All right. So let's go ahead and figure out part A. So first thing that I think you should do is write down the formula that we're going to use. Now, we're going to use the same formula for parts A and parts B. Okay, we're just finding the monthly payments. So the formula, the payment, and all it is this formula right here. Okay, I'm going to just recopy that formula. That's P times R over N divided by 1 minus 1 plus R over N to the negative NT. All right, so for part A, we'll do it right here. All right, so let's see what P is. We need P, R, N, and T to plug into our formula. So let's see, P, that is the $20,000. That's what we're going to borrow. That's the amount of money we're going to borrow. So that is P equals 20,000. Now let's get R. R, that's the interest rate. Well, let's see, for part A, they want to know for loan A, the interest rate for loan A is 7%. So that is 0.07. And then we need N, and it does say monthly payments. So there's 12 months in a year, so N is 12. And then we need T. So let's see, for part A, monthly payments, let's see, we're installment loan A, and installment loan A is a 3-year loan. So T is 3. And so all I'm going to do now is just plug all of this into our formula. So I get my payment to be 20,000 times R over N. So that's 0.07 over 12 And then that's divided by 1 minus 1 plus R over N. So that's 0.07 over 12. And that's raised to the negative N, which is 12, times T, which is 3. And this is going to give me, a payment of, and I punch that in, that's going to be about $618. Okay. And if it, all these, I'm rounding to the nearest dollar. Okay. All right. So that's the answer to part A. That would be your monthly payment. Now let's look at part B. So in this case, P is, well, it's still we're still borrowing the same amount. The only thing that's changing from part A to part B is the number of years and the interest rate. Okay, that's the only thing that's changing. And so P would still be 20,000. R, well, R in this case, that is for loan B, that's 9%, so that's 0.09. And then we've got N, well, that's monthly payments, so that's 12. And then T, that is going to be for 5 years. So T is 5. And so now we plug it into the formula. So my payment is going to be the 20,000 times R over N. So that's 0.09 over 12 divided by, and that's going to be 1 minus 1 plus R over N. So that's 0.09 over 12 raised to the negative N, which is 12, times T, which is 5. And so my payment here is going to be, let's see, when I calculate that, that is going to be about $415. And that kind of, that makes sense. I know that this payment here is quite a bit higher, about a little over $200 higher. But this interest rate over here in the second part, that interest rate's higher than the interest rate in A. But if you notice, look at this. It's loan B is also for 2 more years. So you're looking at 24 more payments. Okay. So that's one of the reasons it's so much lower. Okay. All right. So let's see what part C says. It says compare the monthly payments and total interest for the 2 loans. Okay. The monthly payments, compare the monthly payments and total interest for the 2 loans. All right. So, well, I guess we can just maybe break this up into a chart maybe. Let's see what we've got. All right, so we're going to have this would be the column for the $20,000 loan. And then let's have another one for monthly payment. And then I guess we can do maybe total interest. All right, so this one is going to be the 3-year loan, and this one's going to be the 5-year loan. All right, so we can go ahead and fill some of this out. So the monthly payment here is $618, and the monthly payment here is $415. So let's just look at the total interest for the 3-year and the total interest for the 5-year. All right, so first thing we got to do, let's look at the 3-year. All right, so I did 618. I made $618 payments every month, and there's 12 months in a year times the 3 years. Okay, and so that is going to give me 618 times 12 times 3. That is going to be $22,248. That's the total amount of money that I paid, or that we paid over 3 years. So we want to look at the interest. So the interest on that, the interest is going to be the $22,248 minus how much we borrowed. Well, how much did we borrow? We borrowed $20,000. Okay, and so that's going to be $2,248. So that would be the interest here, $2,248. All right. Now let's do the same thing, but let's do it with the other loan. Okay. So this loan here, we're paying quite a bit less every month. Okay. Let's see how that interest looks. Okay. This right here could be helpful. When you go out to buy a car, you can calculate all this stuff and see which one works out best for you. So I've got the $415, and I'm paying it every month. There's 12 months in a year, and I'm doing that for 5 years. All right. Remember, this is the 5-year loan we're doing now. So that's 415 times 12 times 5. So that's going to be $24,900. So let's see how much I paid in interest. So the interest is going to be the $24,900 minus the amount I borrowed. Okay, so remember, this is the money that you paid back. That's how much you paid back total. This is how much you borrowed. And so that's going to be $4,900. And so the total interest here is $4,900. So you can see the difference in the loans. Okay, kind of makes you look and think about it a little more, doesn't it? I mean, if you can afford to pay the $618 every month, go ahead and do it. You're saving yourself a lot of money here. You see that? You're only paying $22.48 in interest versus $4,900 in interest. All right. So that's some things you might want to look at when you're buying a car. All right, and then this one here is, I'm not going to get into a lot of depth on it, but this is just some terminology. Leasing. Okay, so the leasing is paying a specified amount of money over a specified time to use a product. Okay, it's like a long-term rental agreement. Okay, leasing a car instead of buying one. It's become pretty popular over the past several years, and there's we got 2 types of leasing contracts. We've got this one here, which is a closed-end lease. Each month you make a fixed payment based on estimated usage. Okay, when the lease ends, you return the car and pay for mileage in excess of your estimate. Okay, that's a closed-end lease. And then we have this open-end lease. Okay, each month you make a fixed payment based on the car's residual value. The residual value, that's the estimated resale value of the car at the end of the lease, and that's going to be determined by the dealer. And when the lease ends, you return the car and make a payment based on its appraised value at that time compared to its residual value. Okay, If the appraised value is less than the residual value in the lease, then you pay all or a portion of the difference. If the appraised value is greater than or equal to the residual value, you owe nothing, and you could even receive a refund. All right. So leasing a car, you've got some advantages and disadvantages. So just run through some of those real quick. Advantages of leasing: they require only a small down payment or no down payment at all. Lease payments for a new car are lower than loan payments for the same car. So a lot of people can lease a more expensive car than they would be able to buy. And when the lease ends, you return the car to the dealer, and you don't have to be concerned about selling the car. So some disadvantages of leasing: when the lease ends, you don't own the car, so you pay all that money, and then after that time, you don't own it. Most lease agreements have mileage limits, 12 to 15,000 miles per year. If you know you exceed that number of miles, you might not want to lease. You could have a charge. Okay, they can charge you extra for that. And when mileage penalties and other costs at the end of the lease period are taken into consideration, the total cost of leasing is almost always more expensive than financing a car. Okay, and while leasing the car, you're responsible for keeping it in perfect condition. You're liable for any damage to the car. Leasing doesn't cover maintenance. You'll have to do the maintenance, and there are penalties for ending the lease early. All right. And, a lot of car leases, they can be pretty complicated. So, it's just up to you. And then, you've got to get insurance on a car. Some types of insurance. You got, liability coverage. You've got, and look, I know I'm kind of just talking about this. You can write all this down. You can pause the video and write. Bodily injury liability, that covers the cost of lawsuits if someone is injured or killed in an accident in which it's your fault. Property damage liability, that covers damage to other cars and property from negligent operation of your vehicle. Okay, if you have a car loan or lease a car, you'll also need collision and comprehensive coverage. So collision coverage, that pays for damage or loss of your car if you're in an accident. Comprehensive coverage protects your car from things like fire, theft, falling objects, acts of nature, and collisions with animals. Okay, and there can be big difference in auto insurance rates. So just kind of shop around on that. All right, so I think that's about all I'm going to talk about with insurance. By no means am I an expert on insurance, but that's just kind of the very basics of it. Okay. All right, so let's look at this problem. It says, suppose that you are thinking about buying a car and have narrowed down your choices to two options. Your new car option, the new car option costs $25,000 and can be financed with a 4-year loan at 7.9%. And you have a used car option. So to get the used car, it has it's a 3-year-old model of the same car, and it costs $14,000 and can be financed with a 4-year loan at 8.45%. What is the difference in monthly payments between financing the new car and financing the used car? All right, so it's going to be kind of like what we did in that previous example. So let's go ahead and figure out what the monthly payments on the new car are going to be and what the monthly payments on the used car is going to be. So first, first, as always, let's write down our formula. All right, so there's our formula. So now let's look at the new car option. All right, so we've got the new car option. So we need P, R, N, and T. All right. Oh, I don't know what happened there. All right, so let's take a look at that. So the new car for P, that's $25,000. So here we've got P is equal to 25,000. R, let's see, what's the interest rate? Okay, so the interest rate on the new car is 7.9%. So that's 0.079. N, and okay, what is the difference in monthly payments? So they tell us it's monthly. See right there, monthly payments. And then I need T. All right, so what's T? Let's see. Finance with a 4-year loan. Okay, so we got a 4-year loan. So T is 4. All right, so my payment is going to be 25,000. That's P times R over N. And I think that is, yeah. So that's 0.079. It's 7.9%, 0.079. And so that's 0.079 over 12 divided by 1 minus 1 plus R over N, which is 0.079 over 12, to the negative N, which is 12, times T, which is 4. Right? And so our payment is going to be $609. All right. So we got 609 there for the new car. Now let's look at the used car. All right. And these, I'm just rounding these to the nearest dollar. All right. So let's see, the used car, we need P. Well, let's see, the used car is $14,000. And then we need R, N, and T. So let's see, for the used car, the loan is 8.45%. So that's 0.0845. And it's still monthly payments, and the time is still a 4-year loan. And so we just plug all this in, and so we get our payment is equal to the 14,000 times R over N, 0.0845 over 12, times 1 minus 1 plus R over 12 to the negative N times T. All right. And that is going to give us a payment of, let's see, $345. And so that's the payment for the used car. All right. And then they ask us, what is the difference in monthly payments between financing the new car and financing the used car? So, well, the difference is equal to the 609 minus the 345. Okay. And that is $264. That's the difference in the payments. All right. So you can see there's quite a bit of difference. Okay, quite a bit of difference there. And keep in mind, I know in the last problem there was quite a bit of difference, but remember, one of them was for 5 years and the other one was for 3 years. Both of these are for 4 years, and you can see the payment on the used car is still a lot cheaper. All right. So now let's look at this. It says, okay, so now we're going to talk about some other things that affect your vehicle decisions you may need to make. Cost of gasoline. Okay, different cars get different gas mileage. So your annual fuel expense is going to be the annual miles driven divided by miles per gallon, how many miles per gallon you get, times the price per gallon. All right, so let's work some problems on that. All right, so suppose that you drive 24,000 miles per year and gas averages $4 per gallon. What will you save annual fuel expenses by owning a hybrid car averaging 50 miles per gallon rather than an SUV averaging 12 miles per gallon? All right. And then part B, if you deposit your monthly fuel savings at the end of each month into an annuity that pays 7.3% compounded monthly, how much will you have saved at the end of 6 years? All right. So let's take a look at that. All right. So for part A, all right, what will you save annual fuel expenses by owning a hybrid car averaging 50 miles per gallon rather than an SUV averaging 12 miles per gallon? So let's get the annual fuel expenses for the hybrid and then calculate the annual fuel expenses for the SUV. Okay. All right. So remember, your annual fuel expense is equal to annual miles driven over miles per gallon times price per gallon. All right. So let's figure this out for the hybrid. Okay. So the annual miles that's driven, that's the 24,000. That's going to be the same thing on both of them. All right. So that's 24,000 over miles per gallon. So for the hybrid, let's see, we get 50 miles. Say a hybrid car averaging 50 miles per gallon. So that's divided by 50, and then times, and then gas. In this case, it says gas is $4 per gallon, and that's going to be the same on both of them. And so that is going to cost us our annual fuel expense. When you punch that into your calculator, that's going to be $1,920. All right. Now, let's look at the annual fuel expense for an SUV. Okay, so it's annual miles driven, which that's the same. That's the 24,000 over the miles per gallon. So let's see the SUV. See, the SUV gets 12 miles per gallon. Okay, so that's going to be 12 times the 4. And then when we multiply that together, that is $8,000. So you can see that is that's a big difference there, isn't it? Okay, that's a big difference. All right, now what are they wanting us to do? If you deposit your monthly fuel savings at the end of each month into an annuity that pays 7.3% compounded monthly, how much will you have saved at the end of 6 years? All right, so one thing you may be thinking is, well, I don't know what an annuity is. All right, well, if you're taking contemporary math, you're taking a course like this, you will have already covered annuities. Okay, so if you forgot, this will refresh your memory. All right, so we want to know on the amount of money that we save every year, how much will we have saved at the end of 6 years? Okay, if we put if we put that money into an account. Okay, we're going to put that money into an account. And if you deposit your, deposit your monthly fuel savings. Okay, we had to see when we're going to be depositing it into an account. Remember, an annuity, that's equal payments at the end of each period. So it can be equal payments every month, every year, every 6 months, every 4 months, every week, or every day if you wanted to. Okay, that's what an annuity is, equal payments. Okay. All right, so first thing we need to do is we need to figure out how much are we going to save every month. Okay, well, let's see. So let's maybe do this let's just draw a line here. Well, we just we'll come down here, call this part B. All right, so we have our annual savings is going to be what? 8,000 minus 1,920. And that ends up giving us $6,080. That's how much we're saving every year. So on average, how much do we save each month? How much do we save each month? So the monthly, because remember, we're gonna put monthly payments in. See, it says if you deposit your monthly fuel savings. Now, if it says if you deposit your yearly fuel savings into an account, then we would use this number 6,080. But because it says monthly, we've got to figure out what our monthly savings are. So, well, that's easy. That's just the 6,080 over 12, because there's 12 months in a year. So we're saving about, and of course I'm rounding this, so that's 507. That's how much we're saving. Okay, so we're going to make monthly payments of 507. All right, and we want to see how much will we have at the end of those 6 years. All right, so the first thing I want to do is let's write down the formula for an annuity. And after I write this formula down, hopefully it will refresh your memory. Okay, and that's going to be 1 plus R over N to the NT minus 1. All that divided by R over N. All right, so pause the video and see if you can work it. Plug everything in. All right, so I need to figure out what P is. P is 507. That's our monthly payment. I need R. Let's see, R, that's the interest rate. So my interest rate is the 7.3%. And remember, R has to be in decimals, so 0.073. And then I need N, well, it's monthly, so that's 12. And then I need T, that's the number of years, and it's right here, 6 years. And so that's 6. And so now I just plug all this in. So that's going to be 507 times 1 plus R over N. So that's 0.073 over 12. And that's raised to the N times T. So to the 12 times 6 minus 1. And that is all over R over N, 0.073 over 12. All right. And then when we punch all that into our calculator, we get A is equal to $45,634. So if you went, in this case, if you went with the car that got the better gas mileage, the 50 miles per gallon, versus the one that got the 12 miles per gallon, and you can see how much it's going to cost you each year to run the gas. But then Okay. But then look at this. If you take those savings and you put them in an account, at the end of 6 years, you'll have $45,634. Okay. And look at there. And the fun ends. That was the last problem. All right. So I hope this video helped. Check out my other videos. Give me a like, share, and subscribe. And thanks for watching.